Hey guys, welcome to our channel. This is our fifth video on capital budgeting decision. In this lecture, we will learn about rate of return methods. Now, without wasting time, move towards our topic, that is rate of return method. This method is also known as accounting rate of return methods, as under these methods the accounting concept of profit is used rather than cash inflows. According to these methods, various projects are ranked in order of the rate of earning or the rate of return. The project with higher return is selected as compared to the lower one. It can also be used to make decision as compared to accepting or rejecting a proposal. Now, the rate of return method are classified into four types, that is average rate of return method, return per unit of investment method, return on average investment method, average return on average investment method. Now, firstly, we will discuss first method, that is average rate of return method. Under this method, average profit after tax and depreciation is calculated, and that profit is divided with the total capital outlay, or we can say total investment in the project. It can establish the relation between average annual profits to its investment. So, average rate of return equals to average annual profits upon net investment in the project into 100. Now, understand this with the help of example. A project requires an investment of 5 lakh and it has scrap value of 20,000 after 50 years. Now, firstly, what we need to do, we need to get the net investment, and net investment is calculated by investment minus scrap value. Now, in our case, our investment in the project is 5 lakh and its scrap value is 20,000, and our net investment in the project is came out to be 4,80,000. Now it is expected to yield profit after depreciation and tax during the 5 years amounting to 40,000, 60,000, 70,000, 50,000 and 20,000. Now our total profits came out to be 2,40,000. To get its average, we divided with 5 and our average profits came out to be 48,000. Now our average rate of return is equals to average annual profit upon net investment, that is 48,000 upon 4,80,000 into 100. It comes to be 10%. Now our second method is return per unit of investment method. Here there is a small variation of the average rate of return method. In this method, total profit after tax and depreciation is divided with the net investment. Now, rate of return per unit of investment equals to total profit, that is after tax and after depreciation, upon net investment in the project into 100. Let's take example. A project requires an investment of 5 lakh and its scrap value is 20,000. Now it is expected to yield profit after depreciation and taxes 40,000, 60,000, 70,000, 50,000 and 20,000. Here we need to take the total of profit, not the average one. In first case we take average profit. Now in this case we take total profit, that is 2,40,000, and our total net investment is 48,000, that is 5 lakh minus 20,000, and our return per unit of investment is came out to be 50%. Now our next method is return on average investment method. In this method, the return on average investment is calculated using investment for the purpose of return on investment is preferred because the original investment is recovered over the life of the asset on account of depreciation charge. Now in this we need to take the average of the investment. So average of investment is came with opening investment plus closing investment divided by 2. The rate of return on average investment is total profit after depreciation and after tax upon average net investment, or we can say total net investment upon 2. Now take an example. A project require investment of 5 lakh and its scrap is 20,000 and its profit after tax and depreciation it came out to be 2 lakh 40,000. Now in this case return on average investment is 2 lakh 40,000 upon 2 lakh 40,000 and this 2 lakh 40,000 is our average investment into 100 and our answer came out to be 100%. Now our next method is average return on average investment method. This is the most popular and appropriate rate of return method. Under this, average profit after depreciation and tax is divided by the average amount of investment. Here in this, we take both investment is also on average basis and return on also on average basis. We judge this from this name average return on average investment. How much we can get return on average basis and our investment is also average. And its average rate of return on investment equals to average annual profit after depreciation and taxes upon average investment. Now take an example. A project requires an investment of 5 lakh and has a scrap value of 20,000 and its profit is 40,000, 60,000, 70, 50 and 20,000. Now here we also need to calculate the average return on average investment, that is 48,000, that is our average profit, and we also need to take the average of the investment, that is 2 lakh 40,000. How it came? 4 lakh 80,000 divided by 2 and our average return on average profit is came out to be 20%. Now advantages of rate of return method is that this method is simple to understand and easy to operate. It requires entire earning of the project in calculating rate of return, not only the specific earning as in the case of payback period. This method is based upon the concept of profit, that is can be readily calculated from financial data. Now there are some disadvantages also. First one is that like payback period method, this method ignores time value of the money. That is the most important factor affected the money. It does not take into consider the cash flow which are important than the accounting profit. This method can't be applied to situation where investment in a project is to be made in a parts. Thank you so much for watching this video. If you understand the concept, please like, share and comment and also subscribe my channel. Thank you.